welcome to today's webinar. So we're going to talk a little bit, and if you see me looking off to my side, I've got my computer sitting here waiting to see if Caitlin is going to verify that she's got good audio and visual. And so as we get started, what we're going to talk about today is some things that you'll see happening inside of your portfolio. Pull this over here real quick. We wait for others maybe to hop on here. The changes we've seen inside of the portfolio, you probably got some notices here in the last couple of days, and those notices looked like, and rightfully so, looked like we made a lot of changes into the portfolio, and we have. So first of all, know that these were planned. This is nothing that's like knee jerk, like, oh my goodness, we saw something happening that we thought we had to hurry up and take action on. The changes that took place are things that have been expected. And really, like I said, they've kind of been planned for quite a while. And so let's talk maybe as a starting point, what the backdrop to some of the updates or some of the changes are that we've made. So the first one is what we've seen happening inside of the US markets. So we've seen large cap US stocks really kind of be on a pretty good run here the last number of years. One of the ways that we measure like how expensive are stocks is you look at what's called the price to earnings ratio. You probably hear people talk about PE ratios. You might hear the TV talk about exactly price to earnings. So really what that measures, if you think about ratios, it's price over earnings. So how many dollars am I spending per $1 of earnings inside of a stock? And usually the S&P 500 is somewhere valued around 17. So that would say I pay $17 for every $1 of earnings that company offers. Well, what we've seen over the last number of years is we've seen those price to earnings ratios get more and more inflated. Right now we're sitting around 27. So if you think about that, that says now I'm paying $27 per $1 of earnings. So that's one data point that we've been keeping our eye on. Another data point, we've seen interest rates that had been going through a process of raising for the last, well, I mean, I guess first let's look back over the previous 40 years. The previous 40 years were interest rates going down steadily. And then we saw that trend reverse a couple of years ago and interest rates rise. Now we think we're going to see that trend reverse again and interest rates start to go down. That's another data point. A third data point that we're looking at is what's been happening with inflation and what we think is going to continue to happen with inflation. Fourth would be looking internationally and seeing what valuations look like on more of a global perspective for stocks and other investments. And so as we start kind of putting some of these pieces on the table and start keeping our eye on it, we add then some of the, I don't know, I think about it more kind of short-term market adjusting types of things. For example, presidential election coming up, or Israel and Hamas, or the Ukraine-Russian conflict. Just all of those things, what I would consider to be more, I don't know, short-term in nature. They're going to have an effect on the market, but it's not really a fundamental change in economics or in what we think the market's going to do. But those are also considerations. So as we start looking at all those things and start thinking about what should we do with portfolios, we felt like right now is probably a good time to make some pretty big changes, both with what we've seen happen already and what we anticipate seeing happening kind of going forward. And so maybe one place to start with that would be talking a little bit about fixed income. Maybe let's start there. Let me grab this real quick. I'm going to verify, make sure that all my technology is working out right. So as we do this, so a couple things inside of the browser at the bottom of your Zoom, you'll notice that there's a toolbar. That toolbar offers a couple of different options. One of them is like a Q&A kind of a button. So feel free as we go through this, type in your questions. I'll periodically grab the computer, look to see what questions maybe are coming in and try to answer those. We'd like for this to be as interactive as possible. Secondly, know that we'll open it up at the end. If you do have questions that you're not typing in, or if you want to Hold them until the end. I will leave a little bit of time for you to be able to type them in then, and again, try to be interactive if we can. So let's go back to where I was starting to chat a little bit about our fixed income perspective. So when you hear fixed income, really just know that we're talking about bonds for the most part. There's lots of varieties of it, but just think bonds. And what happens with bonds is that when interest rates go down, bond prices go up. Interest rates go up, bond prices go down. So what we saw for, I'm calling it 40 years, it's an estimation, but from the late 70s, early 80s, all the way through early 2020s, we saw interest rates on a steady downcline or down decreasing path. So think about back when many of you might have bought your first homes. Those homes came with mortgages that were double digits, right? 11, 12% interest rates. Now we're seeing mortgage rates that are, 6, 7%. Everybody's thinking it's terrible. Well, historically, it's not so terrible. But what happened was over that 40-year period, we saw bonds consistently have price appreciation because those interest rates were consistently coming down over that time period. Because remember, interest rates go down, bond prices go up. Well, what happened was once we got to this place where interest rates couldn't go any further, we saw inflation really starting to get out of control. And the Federal Reserve started saying we need to increase interest rates so that we can start to balance things out a little bit. Well, as interest rates go up, you saw bond prices go down. So back through 2022 especially, what you saw a portfolio where your stock prices were hurting because stocks were down and because interest rates were going up, so were bonds. So what should have happened was that you had your bonds, when stocks go down, bonds are supposed to go up, right? But you didn't have that. You saw both of those things going down. We call that correlation. So correlation is when this goes up, what happens to the next asset? So when stocks go up, many times bonds will either stay flat or sometimes go down. They can go up with them, but they're not usually a one-for-one correlation. It's not stocks go up, bonds go up. It's usually stocks go down, bonds go up because people are looking for safety. Well, what happened was that correlation, that kind of opposite effect, was negated throughout 2022. We saw stocks go down and bonds go down. And that was primarily driven based on this interest rate conversation. So what we did with your portfolios then is we moved all of your bonds to what would be considered low duration or short-term bonds. So when you think about that pricing change, the longer term a bond is, the more you're going to see fluctuation with pricing changes. The shorter term, the less volatility you're going to see or less pricing fluctuation. So by us going short term, when bond prices were going up, or interest rates rather were going up, driving bond prices down, then we lessened the blow to the portfolio. Well, right now we think that rates, if anything, are going to start going down, not up. So as rates go down, what's going to happen to your bond prices? Bond prices are going to go up. So now one of the changes that you saw us make inside the portfolio is adjusting some of those holdings so that we can have a little longer duration. Not crazy long, but a little bit longer. Part of it was in anticipation of that happening. Additionally, while we're staying kind of in that fixed income, so maybe I should kind of give you a layout for what buckets of changes did we make. We have changes we made to your fixed income, changes we made to your stock positions, and then new asset classes that we introduced to the portfolio that we hadn't previously owned. So if we just kind of think about this fixed income bucket is what we're talking about right now. Another change or modification that we made is we've shifted, right now, we believe that having some more active management can increase overall returns. So when you think about active versus passive, you have two layers of active management. The first layer is the active management that we're doing. So we're helping to pick which asset classes, which types of investments, that kind of stuff. But of the things that we're picking, we can choose to either have an active manager or a passive manager. A passive manager is one that's going to mimic an index like the S&P 500 or the Ag Bond Index. They're not really going to make any decisions on it other than whatever the index does, that's what we're going to do. That's passive management. And where we use passive management is when we think we've got um, an asset class or a time period where active management is not going to add any real return or any value there. Because as you can imagine, if something's passive, it means it's cheaper. Something that's active is a little more expensive. So inside of your fixed income holdings, not only do we kind of change some of the duration around and make them a little bit more long-term, but in addition to that, we added some more active managers into the portfolio. With the idea that right now we have the ability for those active managers to add some value to what they're doing, or some return is what our picture is. And then finally, one of the changes that we made was we changed around and introduced what we would consider a dynamic bond fund. Dynamic just means that they have some more flexibility in how they're managing those assets. So the purpose for that, or the reason we made those moves, is first, reaction to the interest rates we see going on, reaction to what we anticipate inflation to do. But beyond that, it really is looking to say this is an opportunity for us to kind of introduce some additional diversification into the portfolio. And as we do, if we look at it historically, and we go back to that first conversation around correlation and, when stocks do well and bonds, how do they work together? What this does is it increases the stability of the portfolio, if you will, and introduces things that are correlated differently. So a negative correlation would be one goes up, one goes down. Different correlation just says just because this one goes up doesn't mean this one goes up, but it does something different than the other asset class. So we're increasing the amount of correlation or different correlation that's going on inside the portfolio. We're also increasing the ability, in our opinion, to react to what we think is happening inside of interest rates and what we see happening inside of inflation. And so those are the changes that we're making inside of that fixed income part of your portfolio. Just looking at the computer, just seeing, if anybody has any questions, feel free to type them into that question Q&A section. So let's talk now a little bit about the equity changes that we made. So if you remember, we started out the conversation with saying, we've seen all of these different things kind of going on, interest rates and inflation and valuations inside of US stocks and that kind of stuff. And we talked about kind of having three types of changes: the changes to the fixed income, changes to your equity or stock positions, and then what are we introducing to the portfolio that's brand new. So let's talk a little bit now about the equity side of that. So as I talked at the beginning, we've seen valuations inside of the US stocks. Again, valuations being measured by what's the price to earnings ratio. We're seeing that pretty extended. And so the sense is that inside of large cap stocks in the US, we think that they're fairly highly valued right now. Now, that's not to say they can't go higher, but we're just not seeing as much of a growth story there because of how they're positioned. At the same time, when we look both internationally and in emerging markets, we're seeing opportunities there where those asset valuations are not as high. We're actually seeing where they're a little bit below averages. And so one of the changes that we're making is we are pulling some of our large company US stock positions back. That doesn't mean we're going to zero, doesn't mean we're getting completely out of it. It just means we're taking some of those allocations and reallocating them to more international and emerging markets. That's one of the changes. Another change, though, or maybe this isn't a change, maybe it's just a note, something to note. Our mid and small cap stock positions, we're not really doing anything with those. They tend to do well as interest rates come down, and they're not nearly as highly valued as the large cap part of the US economy is, or US stock market is. So we're not doing anything with those small and mid cap holdings. Large cap, again, we're going to pare back and we're introducing a little bit more international and emerging markets. This is one area where maybe it's kind of it starts to bridge between what are we now introducing into the portfolio. So if you remember, in fixed income, in addition to those changes, we introduced that dynamic bond fund. We're introducing what's called a hedged equity position. So when you think about hedged equity, what that does is it allows us to be invested in, they have some exposure to the US large cap market. But when you hear hedge, it's like, well, what does that word mean? Well, you might maybe hear people say, well, I'm going to hedge my bet. Or I even think about hedge, like the hedge in front of my house. Like, what does that mean? And really what it means is that it's a barrier or it's a protection against certain things happening. So when we look at adding hedged equity, what hedged equity should do is that is the US market maybe corrects or has a pullback, that hedged equity should not be correlated directly with that. So it hedges our bet a little bit, lets us have large cap exposure, but maybe can protect us a little bit if those markets start to correct. So that's something that we're adding into that equity mix as well. And then finally, to kind of wrap up that last bucket around what is completely new that we're adding into the portfolio. And in that regard, what we're really doing is adding in what we're considered real assets. So real assets, when you think about that, it makes it seem like the other things are not real, right? But they are. Stocks are real, bonds are real. But when we talk about real assets, what it really means is things like real estate, you know, and it's an asset that now is producing an income, but it's a building that I can see. It's commodities, those are real assets. And not we're introducing commodities to the portfolio, but just to give you an idea of what different real assets are. And so what typically happens is real assets help to provide some stability to a portfolio. They introduce another layer of diversification. When we talk about those correlation changes, it adds an additional layer of correlation that is different from stocks and bonds. Many times we're getting calls from people that say, hey, I hear all the time that I should be putting all my money into gold, or I should go out and buy a bunch of real estate, or I should, and there are some good arguments for why should real assets be in a portfolio. And one of those is diversifier, and one of them is that it's a good way to try to make some additional returns. Typically, however, that real asset category does not have as good of a risk return payoff as your other more traditional types of investments. And so when I say risk return payoff, what that means is I can see a lot more fluctuation or volatility in that asset class and not necessarily see a lot more return compared to if I had it in stocks or bonds, a little more traditional investments. However, it is a good diversifier and it is a good kind of offset to what's going on inside of other asset classes. And so the addition of real assets, that's why we're adding it. The reason I share that it doesn't always have the best risk return ratio is that we're adding it in incremental amounts, 2%, 5% to the portfolio, not adding it in, you know, we're going to make that the equal weight to like stocks or bonds. But I'll let you know because it is a fairly significant shift in what we've done previously. So all of that sounds like a lot, and it is. You know, the portfolios have really kind of gone through a fairly major overhaul at this point. But the reason for that is not like, oh my goodness, they must be seeing something terrible happening. Not at all. We are seeing, however, a shift in what was and what we think is going to be. And really this is in trying to be proactive in that regard. We're happy with the way returns have been over the last 12 to 18 months. As you've gotten your statements, you've seen that we've taken advantage of and participated in a lot of the market upswing. This is just a way for us to continue to be proactive in what we're doing. So that's about all of my kind of planned or prepared remarks. Please feel free. I've got a couple of questions that are coming in that I'll pull up and we'll answer those. While I'm pulling that up, just want to put a shout out there also. You know, we do have our podcast that is released every 2 weeks. So feel free to please sign up and subscribe to that. If you want to see me and Katie more on your feeds. So one question was, where do the active managers come from? So the active managers are really a variation of things that we've already been doing. So if you think about mutual funds and exchange traded funds, you can choose to buy mutual funds or exchange traded funds in either an active style or a passive style. And so, and many times it's even the same manufacturers of those funds. So for example, I'll pick on Vanguard, maybe. So some of Vanguard's ETFs could be, and I'm not thinking of anything specific, but could be an actively managed ETF. Or they could, in let's say the large cap space, or it could be they offer an ETF that is completely passive and follows uh, just an index. And so where those active managers are coming from is we're looking at the same pool of options that we've had, which is really kind of the whole world of investment options. Um, it's not kind of specific that way. The difference is that, are we choosing for that to be active or passive, and how that's being managed. Another question just says that if interest rates go down, expect the price of an individual bond to go up. But will the share price of a bond mutual fund also be expected to increase? Long and short answer is yes. What happens is bond mutual funds are made up of, they're an amalgam of all of the underlying individual bonds. And each of those bonds, as we look at how that fund is made up, has a weighted duration to the fund. And so because it's an amalgam and because it's an effect of all of the individual holdings, if interest rates go down, we would absolutely expect to see those bond prices go up, which then be reflected in the NAV or the share price of that mutual fund. All right, so again, we've got the ability, if you want, down in the lower toolbar, move your cursor and it'll maybe bring up the toolbar for your Zoom meeting. If you have questions, feel free to type them in. And so question is, what's the example of proposed hedged equities? Yeah, so there too, we're going to be using funds in that space. And let's see if I got it here. Sorry, what I'm doing, Mike, is I'm looking to see if I've got the ticker symbol here on my sheet that I can tell you the exact ticker that we're going to be using. And for some reason, I'm not seeing it here. Oh yeah, here it is. I'm sorry. It's the hedged equity is actually a JP Morgan fund that we're going to be using. The ticker symbol is HELO. If you want to look it up. And depending on which portfolio you've got. So when I say which portfolio you have, we're really looking at am I a conservative investor, moderately conservative, moderate, am I aggressive? Where do I fall in that spectrum? And depending on what type of investor you are will depend on how much of that fund is inside of your portfolio. And so right now, the range for that, you could see anywhere from 2.5% of your portfolio to 5% of your portfolio in that hedged equity position. But that's the specific one that we're buying inside the portfolios right now. A question came in around fee structure and that kind of stuff. There's been no change in PrairieView's fee structure. The follow-up question to that by somebody else was saying, hey, are actively managed funds more expensive than non-actively managed funds? So there are two different fees that are associated with any portfolio. One fee is a PrairieView fee for actively managing those portfolios. That fee structure has not changed. We haven't changed that fee structure since we've been in business. So that's not, and I don't see that happening. When we look at the second part to that question around, okay, well, what is it costing me underlying fund wise? And is that more expensive? Active managed funds are more expensive than passively managed funds. However, know that, I mean, that's obviously one of the evaluations that we look at when we're talking about should we buy a fund and which fund are we going to buy? To put it into perspective, PrairieView's fee structure says, and I'll just use $1 million investment because it's easy. So $1 million investment has a 1% fee that PrairieView charges. Our fee structure is such that the more you have, the lower the percentage is that we charge, and vice versa. The lower the dollar amount, the fee structure is a little bit higher. But if we just use that $1 million example, so you've got a 1% PrairieView charge. When we were completely passive in the management of those funds, your all-in cost would have been somewhere around 1.08 to 1.13% depending on whether you were conservative or aggressive. Now, with this new introduction of kind of some active managers, instead of that 1.08 to 1.13, now you're gonna see your fee structure look more like 1.18 to 1.33. So again, it depends on, what the mix is, whether you're conservative or aggressive, and which what percentages of each of those funds we have inside the portfolio. So we will see a slight increase in total fees or total drag on the portfolio. In our opinion, though, it's not a significant enough drag to warrant doing something different. We still think that having those active managers is going to more than offset the increase in fees that they charge to actively manage it. But that being said, that's why we're very intentional around, if we don't think an active manager is going to provide value or return, we call it alpha. If they're not going to provide alpha, then we're not going to hire them. We're not going to pay the extra fee. In the funds where we're choosing to have that active management, they're all funds where we fully anticipate that manager is going to give us a return on that extra fee, not just cover the extra fee. So as we kind of come to a close, if there's other questions, please enter them in. If you have questions though, and you're like, hey, I'm not the type that likes to, type my questions out, or I don't like to talk in front of the class type of stuff, feel free to shoot me an email, give us a phone call. You want to have a meeting, more than happy to do that. I mean, we're here to be of service to you. So whatever way we can do that, please let us know. And again, we have, this will be recorded, or is being recorded. We're gonna wrap it up and send it to you, probably via email with a link. It will be posted on our website in our resources section. You can also go there and find lots of other stuff. You can find videos that we put together that help walk you through how to access Black Diamond or our app on your phone. There'll be resources out there that helps to show how can you aggregate your investments into one place so that you can have a complete picture of your financial profile, and we can help give you good advice on that. So those things are there all the way to our podcast episodes. We'd invite you to engage as is best for you. Like I said, whether it's an email, a phone call, you want to set up a meeting, just let us know. We'd love to talk to you. And just know the changes, again, just reiterate, the changes we're making here, really, it seems like a lot, and it is, but it is a very measured, planned out, I guess, course. We just decided, or just thought that it might be nice to have a webinar. We haven't talked to you for a little while, so it might be nice to have a webinar and let you ask some questions if you have them. So if you have more, let us know. Otherwise, we thank you all for attending, and we'll talk to you soon. Be well.